Hello guys, welcome back to my channel. My name is Andrea. In this video, I want to go over the UPS because currently at the time of recording of this video, they are paying 7.9% dividend yield. So I want to look if the dividend yield is safe, how they are doing with their restructuring and cost cutting plans, and overall over the financial health. So the United Parcel Service, or shortly UPS, is one of the world largest logistic companies. They are making revenue around 90 billions and operating in more than 200 countries worldwide. And recently there is some uncertainty about the UPS because their shipping volume is going down. They are doing this restructuring and this is causing the stock go down sharply, and that's why they have so attractive dividend yield now. So as mentioned during the time of recording this video, they are paying dividend yield 7.9%, which is pretty juicy, and their average dividend yield is 3.5%. They are a solid dividend play because they have a good history of increasing the dividends. They increased their dividends over the last 16 years. And if we look on this stock from the view of the dividend yield theory, which is very simple but powerful tool, the dividend yield theory say that every stock have its average dividend yield. In case of the UPS, it's the 3.5%. And the stock is sometimes over this average and sometimes under this average. But in general, the stock will always tend to return to this average dividend yield, assuming the dividends stay constant. And in this case, if the dividends stay constant from the current levels, it will mean that the stock needs to rise around 120% in order that they return to their average 3.5% dividend yield, which is a really solid upside, especially if we can lock ourselves in this 7.9% dividend yields and get paid for waiting the upside to realize. If we look on their financials, on the last year they was able to make around 10 billion in the operating cash flow and 6 billion in free cash flow. And here is the catch. The dividend they are paying now is making around 85 to 90% of the free cash flow. They have also some debt they need to pay from this free cash flow, so there is not much room for error. When we look on their balance sheet, we can see that they have a debt of $25 billion, from which 1.7 billion is due this year, but this debt is stretched over the very long time. There are some maturities which go until the 2064. So a lot of stretched debt, which is good because they don't have as much stress to paying this debt down. They have also good credit rating. They have single A credit rating from the S&P. That's why we can apply dividend yield theory in this case. And basically what they are saying is they are doing this restructuring program. So they are cutting on workforce, they are cutting on some buildings which are not optimally used, and this should bring them around 1 billion annual savings. So in the future there will be more free cash flow. And then there is this uncertainty with Amazon. So the UPS said that they want to move the customers where they have higher margins. And with the Amazon, they have a low margins, but a lot of volume. So they made a mutual agreement with Amazon because Amazon is building its own logistic, that they want to reduce the volume by 50% by 2026. And this is also why they are cutting on the workforce and some logistic hubs. So there are some uncertainty in the short run, but if they can execute good, if they can save on the workforce and on the logistic hub and more automate their operations in the future, their margins will go up even if the volumes go down. But I understand that there is some uncertainty and there is always this if they can execute as they plan. So to sum this up, the UPS is a buy according to dividend yield theory because the dividend is over the 5-year average dividend yield. Actually, it's on the 10 years all-time high with its 7.9%. If they can execute good, the dividend will stay safe. We can look now in this 7.9% dividend yield, which is also very good. And there is a big stock upside potential. But as I said, there is not much room for the error because their free cash flow is running hot with the dividend what they are paying now. So as always, this wasn't any financial advice. Please always do your own research before investing in anything. If you find value in this video, please give me a thumbs up and subscribe to this channel. So I hope you'll see you in the next one. Bye!